Gold just did something it hasn't done all year. It fell. Under $4,000 an ounce. And instead of panic, something strange happened at the counter of a small bullion shop. Sales didn't slow down. They jumped 4 to 5 times higher than normal. 90% of the buyers were repeat customers, people who track the market like a heartbeat. So the question is not whether gold is falling. The question is, what do these buyers know that the rest of the market hasn't priced in yet? Because history shows when the informed money moves quietly, the crowd usually finds out last. Welcome back to Precious Metals Intelligence, the channel built for those who prefer facts over noise and strategy over speculation. If you're new here, glad to have you. Before we go further, it would help to know where in the world you're watching from today. Drop it in the comments below. And if this kind of grounded, no-hype economic analysis is useful to you, consider subscribing. Not for algorithms, not for numbers, but because in times like these, staying informed isn't optional. It's a responsibility we take seriously for viewers who've spent decades building what they now need to protect. Gold has always been seen as a symbol of safety. For decades, people have turned to it when they felt uncertain about the future. But in 2026, something happened that made even longtime investors pause and take notice. Earlier this year, gold reached an all-time high. It climbed above $5,400 an ounce, a number that once seemed unthinkable. Analysts called it historic. Buyers celebrated. It felt for a moment like gold could only go higher. But markets rarely move in a straight line. In the months that followed, gold began to slide, slowly at first, then faster. And last week, it reached a point that shocked many people watching closely. Gold closed below $4,000 an ounce, its lowest point of the entire year. For most people, a falling price means fear. It means hesitation. It means investors pulling back and waiting to see what happens next. That is the normal pattern. That is what most headlines predicted. But that is not what happened. Instead, something unusual took place. A bullion dealer, someone who sells gold and silver every single day, noticed a dramatic shift the moment gold dropped under $4,000. Sales did not slow down. They surged. In just 1 week, this dealer sold 4 to 5 times more gold than he normally would in an average week. That number alone is striking. But what makes it even more interesting is who was buying. According to the dealer, about 90% of the people purchasing gold that week were not new customers. They were repeat buyers. People who had bought from him before, people who track prices closely, who understand the market, and who do not make decisions based on emotion or panic. This detail matters. When new, inexperienced buyers rush into a falling asset, it often signals fear or confusion. But when experienced buyers move quickly and with confidence, it signals something else entirely. It suggests they saw an opportunity. It suggests they had been waiting for exactly this moment. Think about that for a second. While casual observers were reading headlines about gold crashing, a group of seasoned buyers were quietly doing the opposite of what fear would suggest. They were buying more. This is the paradox at the center of the story. Gold was falling in price, yet demand for it was rising. Two things that, on the surface, do not seem to belong together. Why would that happen? One possible answer lies in psychology. Round numbers carry weight in the minds of buyers. $4,000 is not just a price. It is a symbol. When an asset drops below a big, easy-to-remember number, it can trigger a certain kind of decision-making. For some buyers, seeing gold dip under $4,000 may have felt like a signal that the price had reached a level worth acting on, even if that number carries no real mathematical significance. Another possible answer lies in experience. People who have followed gold for years often develop a sense of when prices feel low relative to where the market has been. They are not guessing. They are comparing the current price to years of history, patterns, and past behavior. When the price drops to a level they have been watching for, they often act quickly before the opportunity passes. Either way, one thing becomes clear. This was not random buying. This was not panic. It looked deliberate, calculated. The kind of buying that happens when informed people believe they understand something the broader market has not yet priced in. And that raises a bigger question, one that reaches far beyond a single bullion shop or a single week of sales data. If experienced buyers are treating a falling gold price as an opportunity rather than a warning, what does that say about how they view the future? What do they see coming that the average investor, focused only on daily headlines, might be missing? This is where the story becomes important, not just for people who collect gold and silver, but for anyone trying to understand where money is quietly moving during uncertain times. Because often, by the time the wider public notices a shift, the people who move first have already positioned themselves. The next part of this story looks deeper into another number tied to this same moment. A ratio that, historically, has told investors exactly which metal to favor. And right now, that ratio is sending a signal that most buyers appear to be ignoring completely. Numbers do not lie, but they are often ignored. And right now, there's one number in the precious metals world that most casual investors have never even heard of, yet professionals watch it closely, almost like a compass. It is called the gold to silver ratio. In simple terms, it tells buyers how many ounces of silver it would take to equal the value of 1 ounce of gold. This ratio moves up and down over time, and for decades, experienced investors have used it as a guide. When the ratio climbs very high, it usually means silver has become cheap compared to gold. When it drops low, it often means the opposite is true. Right now, this ratio sits at around 70 to 1. That means it takes roughly 70 ounces of silver to equal the value of a single ounce of gold. To put that in perspective, earlier this year, that same ratio was closer to 46 to 1. In just a few months, the gap between the two metals widened significantly. For most of 2026, this ratio has stayed relatively balanced, but recently it climbed to its highest point of the entire year. Historically, when the ratio reaches levels like this, informed buyers tend to lean towards silver, not gold. The logic is simple. If silver is unusually cheap compared to gold, then silver may offer more room to grow in value once prices normalize again. And yet, that is not what is happening. Despite the signal, the surge in buying reported by the dealer was almost entirely in gold, not silver. Buyers were choosing the metal that, according to the ratio, was the more expensive option. This creates a genuine puzzle. Why would experienced repeat buyers move toward gold when a well-known indicator was quietly pointing them in the opposite direction? There are a few possible explanations, and each one reveals something important about how people think during uncertain times. The first explanation involves stability. Over the past year, silver has experienced far more dramatic price swings than gold. At one point, silver reached highs near $120 an ounce. Since then, it has fallen by roughly half. Gold, on the other hand, has also dropped from its own record high, but not nearly as sharply. If gold had fallen by the same percentage as silver, it would now be trading far below $3,000, not sitting just above $4,000. This difference matters to buyers who value predictability. Even though gold is more expensive per ounce, its price movements tend to feel less extreme. For someone who is risk-averse, meaning they prefer to avoid large, sudden losses, that steadiness can feel more important than chasing a potentially higher return. The second explanation is psychological. Falling below $4,000 gave many buyers a clear, memorable trigger point. Even if the ratio suggested silver was the better mathematical choice, the emotional pull of gold dipping under a major round number proved stronger for many buyers. People do not always act purely on logic. Sometimes a simple, recognizable milestone can influence decisions more than a technical indicator most people have never studied. The third explanation is about long-term positioning. Some buyers may already hold significant amounts of silver and were simply looking to balance their holdings by adding gold while it looked relatively affordable. In other words, this was not necessarily a rejection of silver, but an attempt to diversify at a moment that felt right to them. Whatever the true reason, this moment highlights something important about markets in general. They do not always move the way textbooks and ratios suggest they should. Human behavior, emotion, timing, and personal experience often shape decisions. Just not everyone who wants to own gold can actually afford it. This simple truth becomes more important the higher the price climbs. And with gold sitting above $4,000 an ounce, a growing number of buyers are running into a barrier that has nothing to do with belief in the metal and everything to do with the size of their wallet. For someone with significant savings, spending $4,000 on a single ounce of gold might feel reasonable. But for the average person, that amount represents a serious financial commitment. This is where the idea of fractional gold becomes important. Fractional gold simply means smaller pieces of gold, such as 1/10 of an ounce or even a single gram. These smaller pieces allow buyers with less money to still participate in the gold market. But there is a catch, and it is one that many new buyers do not fully understand until they experience it firsthand. Smaller pieces of gold almost always come with a higher premium. A premium is the extra amount a buyer pays above the actual value of the metal itself. On a full 1 ounce coin, that premium is relatively small, but shrink that coin down to 1/10 of its size, and the premium per ounce increases significantly. In some cases, buyers end up paying hundreds of dollars more per ounce just for the convenience of a smaller, more affordable piece. This creates an uneven playing field. Wealthier buyers can purchase full ounces at lower relative cost, while everyday buyers are often forced to pay more per ounce simply because they cannot afford the larger piece all at once. In a strange way, being unable to afford gold in bulk becomes its own financial penalty. This affordability gap became even more visible through a real example connected to the United States Mint. In 2026, the Mint released 2 special commemorative coins, often referred to as bells, one made of silver and one made of gold. The silver bell was priced at $750, which worked out to roughly 15 times the actual spot price of silver. Despite that steep premium, it sold out almost immediately. The gold version told a very different story. Priced at nearly $20,000, it carried a premium of about 5 times spot price, a much smaller markup compared to the silver bell. Yet, unlike the silver coin, the gold bell did not sell out. In fact, both versions remained available for purchase well after release. At first glance, this seems backwards. The silver bell had the higher premium, yet it disappeared from shelves almost instantly. The gold bell had the lower relative premium, yet demand for it was noticeably weaker. The explanation comes back to a single word: affordability. Even collectors who are financially comfortable have limits. Spending several $100s on a collectible is manageable for many people. Spending nearly $20,000 is not, no matter how rare or symbolic the item may be. This example reveals something important about the entire gold market right now. Price alone does not determine demand. Access does. A large portion of potential buyers are simply priced out of full ounces, pushed instead towards smaller, more expensive per ounce options, or towards silver altogether. This affordability wall also helps explain part of the earlier mystery from the gold to silver ratio. While experienced, wealthier buyers may be comfortable purchasing full ounces of gold even at elevated prices. Everyday buyers with more limited funds are often nudged towards silver, not necessarily because they believe it is the better long-term investment, but because it remains the more realistic option. In other words, the market may be quietly splitting into two separate groups. On one side are buyers with enough capital to acquire gold directly, treating recent price drops as opportunities. On the other side are buyers who want to participate but are limited by cost, often. Markets rarely repeat themselves exactly, but they often rhyme. And for those willing to look back at recent history, the current gold and silver situation is not entirely new. Similar patterns have played out before, and they offer a valuable warning for anyone tempted to chase premium-heavy purchases without understanding the long-term outcome. Consider the example of previous United States mint releases. In past years, certain commemorative coins launched with enormous premiums, sometimes selling for many times their actual metal value. At the time, demand was intense. Buyers rushed to secure their piece, worried they might miss out entirely. Resale prices on the secondary market climbed even higher in the days following release. But that excitement rarely lasted. As time passed, the same coins that once sold for well over $1,000 gradually declined in value. Some eventually traded for a fraction of their original price, sometimes 80% lower than what early buyers paid. The lesson here is simple but important. High initial demand, especially demand driven by fear of missing out, does not guarantee lasting value. In many cases, it means the opposite. Prices inflated by emotion tend to correct once that emotion fades. This historical pattern matters right now because it applies directly to the silver bell that sold out almost instantly. Just weeks after release, resale prices on the secondary market were already climbing well above the original selling price, in some cases reaching several $1,000s for a single coin. If history holds true, that premium will likely shrink significantly over time, just as it has with past releases. This is not simply a lesson about collectible coins. It is a broader lesson about the difference between buying based on urgency and buying based on strategy. This distinction becomes even clearer through a real transaction that took place recently between a dealer and one of his long-term customers. This particular buyer had a history of using the gold to silver ratio to his advantage, rather than simply reacting to price movements. Instead of buying silver or gold outright with cash, he approached the dealer with a different plan. He offered to trade 14 ounces of gold directly for 1,000 ounces of silver, using the current ratio between the two metals to structure the exchange. Because the ratio was sitting near 70 to 1 at the time, the trade worked heavily in his favor. Based on his own calculations, the silver he received effectively cost him somewhere around $28 per ounce, a price far below where silver had been trading through much of the year. He did not wait for the market to hand him a discount. He created one himself, using knowledge of the ratio as a tool. This example stands in sharp contrast to the earlier stories in this analysis. It was not driven by fear of missing out, nor by the emotional pull of a round number like $4,000. It was calculated, deliberate, and based on a clear understanding of relative value between two assets. This is the pattern that separates reactive buyers from strategic ones. Reactive buyers respond to headlines, price drops, and urgency. Strategic buyers respond to relationships between assets, historical patterns, and long-term positioning. Both groups are active in the market right now, sometimes at the very same counter on the very same day. Understanding which group a person belongs to may matter more than most realize, because as history has shown again and again, the buyers who move with strategy rather than emotion are often the ones who come out ahead once the noise settles and the numbers return to balance.